Once you've retired, one of the most important financial decisions that you're going to make is order of withdrawal from your various types of retirement accounts. A lot of times people have pre-tax retirement accounts like 401ks, IRAs, they have after-tax cash or brokerage accounts, and then they have Roth IRAs. And the question becomes, okay, if I need $80,000 a year, where's the most tax efficient way to withdraw that from? And making a mistake in this category can cost you thousands and thousands and thousands of extra dollars in taxes over your lifetime. Hello everyone, I'm Michael Mruger. I am the managing partner of Greenbush Financial Group, and we do this type of distribution planning strategy for clients all the time. And clients are often very surprised to find out that the order is not just, hey, take your after-tax cash and brokerage stuff, then you move on to your pre-tax stuff, then you leave the Roth for the last. The distribution strategy is actually much different than that, when a lot of times people are taking pre-tax intentionally right out of the gates, and I'm going to explain why. The main reason why individuals will often start by taking at least a portion of their income need from their pre-tax accounts like their traditional IRAs and 401ks is they have just entered the retirement year. So for the first time in a very long time, they are in a low to medium tax bracket. Let's say they were making $300,000-400,000 during their working years, always in high brackets, but now they're only showing a little bit in Social Security and the rest has to just come from their assets. By not taking money out of their pre-tax accounts right off the bat, they might be wasting low income bracket years that cannot be made up in future years. For example, let's say Scott and Kelly just retired, and prior to retirement, their combined income was $300,000. Scott and Kelly have a cash reserve of $100,000. They have an after-tax brokerage account with $250,000 in it, and then they have traditional IRAs totaling $800,000. Since their only fixed income source in retirement is their Social Security, which is $60,000 a year, if they need an additional $20,000 per year to meet their annual expenses, it may make complete sense for them to withdraw all of that money from their traditional IRA as opposed to using their cash reserve or brokerage account. There are three main reasons why this may be true. So reason number one is, for a married couple filing a joint tax return, the 12% Fed tax bracket caps out at $96,000, which is relatively low. If they need an extra $20,000 after tax to meet their expenses, they can just gross up their traditional IRA distributions by 12% to cover their Fed tax, which would be a gross distribution of $22,727. They take the Fed tax out and that gives them their $20,000 and they're still in the 12% Fed bracket. Reason number two is if they don't take withdrawals from their pre-tax retirement accounts and they just live off their cash and brokerage accounts, those pre-tax retirement accounts are going to keep growing, and at age 75, Scott and Kelly will be required to take required minimum distributions or RMD from their pre-tax accounts, and those RMDs could be very large and push their taxable income up into the next 22% Fed tax bracket. And there's a third reason, which has to do with state taxation, which is for states like New York that have state income tax. And depending on the state that you live in, they may provide an annual state exemption for certain amounts of distributions from pre-tax retirement accounts. Like in New York, they do not tax the first $20,000 of pre-tax distributions from retirement accounts for each taxpayer. By not distributing in the early years of retirement, a retiree might be wasting their $20,000 New York State tax-free, making a larger portion of their IRA distributions subject to state tax in the future. This distribution strategy is not an all or nothing. So in the scenario I gave you, they were taking their full $20,000 out of their pre-tax IRAs. But if they needed more than that, it might be, hey, let's take $20,000 into your pre-tax IRAs. That's at a relatively low rate. And the rest we will take from your after-tax sources. Which is a great segue to the next type of account within this order of distribution, which is usually after-tax brokerage accounts or cash reserves. So individuals that are over the age of 59 and a half, there usually is a blend between pre-tax first and then after-tax brokerage. But the reason why after-tax brokerage is next is there's some tax advantages that if for some reason something hasn't appreciated a ton in value, those holdings can be sold and there isn't that much of a tax impact to then withdraw cash from that after-tax brokerage account. But retirees have to be careful about selling holdings that have appreciated a lot in value, because selling something that has appreciated could trigger either short-term or long-term capital gains, which would add to their income. But even for retirees that have big unrealized gains in their brokerage account, it still might be favorable to take some distributions at a gain in those accounts versus taking more out of an IRA because of the preferential tax treatment of long-term capital gains. If you bought something and held it for more than a year and you sell it, most taxpayers at a federal level will pay a flat 15%, whether you realize $100,000 or $300,000, which is usually much better than the ordinary income tax rates, which go up as those income amounts increase. Now let's pause for a second. Now remember I mentioned we kind of look at pre-tax first and then we go to after-tax. There is a subset of clients where that gets reversed, where after-tax becomes seat number one. And that's typically for clients that retire prior to age 59 and a half, and some clients that retire before age 65. We're going to look at both of those. So clients that retire before age 59 and a half, if all they have are pre-tax IRA accounts, if they take distribution from those prior to 59 and a half, not only is it taxation, but they also have to pay that 10% early withdrawal penalty. Because that 10% early withdrawal penalty exists, we'll usually try and avoid taking money out of pre-tax IRAs and start to favor those after-tax brokerage accounts or cash reserve to meet their income need. Now, just kind of know, if you have 401k plans, there is an exception within 401k to the 59 and a half rule that if you left the employer that has that 401k balance after age 55, you can actually take distributions from that 401k account even though you're under the age of 59 and a half and avoid the 10% early withdrawal penalty. So that's the retirees under 59 and a half. Now there's another subset of retirees that retire before age 65 that sometimes will favor the after-tax brokerage over pre-tax, and that's largely around the health insurance issue. So 65 is the big age where everyone qualifies for Medicare, but if you retire before 62 and you don't have any type of retiree health benefits, most of those retirees are going to the state exchange to get their coverage, and the state exchange has income subsidies available. Because those subsidies are income-based, we may want to intentionally have that retiree show very little income until they reach age 65 when Medicare takes over. So instead of taking out a pre-tax accounts, which is adding income, making their health insurance more expensive, we might intentionally want to take money out of after-tax accounts to show less income so they qualify for more subsidies. The last stop on the distribution train is Roth dollars. So Roth by far is the most valuable source over the long term for so many reasons. So when we look at Roth IRAs, we don't usually want to spend those first or second because all the accumulation that happens within those accounts is tax-free. So we want those things to accumulate as long as possible. So if that retiree has to access money in the future, that money is not taxable to them. Versus if that money continues to accumulate in a traditional IRA, all those accumulations are taxable. Also, if there's going to be money left to the next generation, you would much rather inherit a Roth IRA versus a traditional IRA, especially with the new 10-year non-spouse beneficiary rules. You inherit a pre-tax traditional IRA, you have to fully deplete that as a non-spouse beneficiary within 10 years and pay tax on all of it. If instead you inherit a Roth IRA, you do have to deplete that account in 10 years, but you could take no distribution for 10 years, double that thing again, and then year 10, you don't pay any tax on any of it. There are a few more special considerations within the distribution strategy. And the first one is with regard to health savings accounts. So with health savings accounts, you can use those accounts to pay future medical expenses tax-free. So if someone retires early enough, and we know they're going to have a long life expectancy with future medical expenses most likely in the mix, we will usually encourage them not to use that health savings accounts immediately. Let that account continue to grow because all the earnings grow and are distributed tax-free as long as they're used for future medical expenses. The distribution strategy also impacts the timing of filing for Social Security. So if we have one of these clients that's in a relatively low bracket and they have other assets, while immediately might be, well, I'll turn on my Social Security to get the free government money. That might not be the best tax strategy because Social Security for many people are subject to taxation. So by delaying Social Security until a later age, we get one, the automatic increase in the Social Security benefit, but two, that taxable income is no longer on the table. So we might be able to take larger distributions from pre-tax retirement accounts, either to distribute for income or do Roth conversion to fill up those lower brackets. There are a number of big mistakes we see retirees make, and I just want to highlight those two. So the one is they don't understand how the Medicare IRMA works. So the way Medicare works when you turn 65 is it's also income-based. Under a certain threshold, everyone kind of pays the same amount out of their Social Security. But once your income starts increasing, those Medicare premiums that come out of your Social Security benefit every month start going up, and it doesn't give you any additional benefit. So by not doing proper distribution planning, not only do you make those retirement dollars potentially subject to higher income tax rates, but you could also end up paying much larger premiums for Medicare. Whereas if you structured your distribution plan separately, you might be able to keep your income lower over your lifetime, not making those Medicare premiums go up. The second big mistake is missing out on Roth conversion years. So this is very common for individuals that have pensions, they have Social Security, and they come in and they say, hey, Mike, between my pension and Social Security, I don't really need anything else. We're just gonna let everything just keep growing. No need to put more income tax on the table. But what they don't realize, again, is if they don't start taking distributions from those pre-tax accounts, by the time they hit 73 or 75, they're going to be forced to take money out at much larger amounts, missing out on the potentially state exemptions and lower tax brackets. But if they don't need the money, maybe one of the ways is to do a Roth conversion where you're shifting money from your pre-tax IRAs over to a Roth. Roth IRAs are not subject to RMDs, they accumulate tax-free, and if you're going to leave money to your beneficiaries, it's better to leave a Roth than a traditional. And the third mistake, which is the most common that kind of led into this whole conversation, which is people just blindly taking after-tax sources first, whether it's brokerage and cash, depleting that stuff, moving on to pre-tax, where usually it's a better overall tax strategy to do some blend of the two. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.